Hi all, welcome to TCM Education. In this video, which is complementary to our Day Trading Explained series, we want to focus on the concept of smart trading and explain it, and it's actually not very complicated. Instead of focusing on stocks from various sectors, on various screeners, gappers up or gappers down, stocks from various sectors, or stocks from a list that you are basically working with on a daily basis. We think that the best thing to do is gather the most important stocks to day traders in one concise, very small list. And what is this list? How do you get into this list as a stock? This is the description here that you have in front of you. So stocks above $10, that's trivial. Stocks that are above 5% in the money. I'm talking about longs right now, of course. The same will be done for shorts. Stocks that their volume is at least 5 million shares. That means that once a stock is over 5 million, it stays in the list until the end of the trading day. While if a stock is at 1.5% and then 7% but drops back under 5%, it disappears from the list. And the most important factor is this range percentage above 5%. Okay, so range percentage above 5%. So those stocks in the list, and you see that out of 6,000, we have on the list only 16. Only 16. We can eliminate more. For example, if I'll increase my demand from the range to be from 5 to 8, you see that the number dropped from 16 stocks to 12. Okay, so if let's say I have, if I'm looking at 5% range and I have 30 stocks, let's say it can happen, I will increase my demand. I want more strength, more intraday volatility, because the intraday range measures actually intraday volatility. So this list puts me in a place where I'm basically looking for trades at the best of the best of the best, in this case 12 stocks out of 6,000. What is the probability of a stock to make it to this list? Close to zero. It needs to be very strong. Something very intrinsic, very strong happens. I mean, look at those numbers. Most of those stocks are up nearly double digits. So let's see examples. We've seen them in other videos, but let's repeat, because repeating in this case is actually very powerful. AAOI. You can see that this stock trades higher on a gap up, hits 28 where it's a optional buying point. I mean, there are many others, even cheaper, and then runs from 28 to 31. That's $3. That's 10% actually a little bit more than 10% intraday in a matter of 1 hour. Now, how much money can you take out of this trade? Can you take the full $3 times the full 10% times the number of your position, in this case $10,000? Then you take $1,000. If your position is $5,000, you take $500. And if your position is $40,000, you take $4,000. But you cannot sell at the highs. I mean, it's not like you get an insight that the stock is turning around at 31. But you can manage it technically, and this is a chapter that we are learning in our Day Trading Explained course. Okay, whether you're going to go through it or not, that's your problem. Having said that, taking $1.50 out of $3, not a big deal, okay? And in this case, so the reward here is 5%. 5% on a trade where the risk was 1%, that's 5 to 1 intraday, not on a gap up or taking risk or a lot of risk. And in this case, you see, guys, that our strategy is not working 100% of the time. In this case, instead of closing at the highs of the day, the stock actually comes back, and if you wait at the entry, okay, so you lose this trade. but it's not reasonable to lose a trade that's already 10% in the money and end up with nothing. That never happens to a good trader or a smart trader. So that's example number one. Again, out of this list of 12 stocks, let's see another example. Very easy. I think most of you have seen or should have seen this example. SolarEdge closed up 16%, nearly 17% on half a trading day. Same strategy, risk 1% on a pullback. And then the stock runs higher $2 from, you can see, 25.50 to 27.50. How much is it? That's 8%. So on a $10,000 position, $800. $5,000 position, half of that. $20,000 position, double that. So $1,600 on a small position. I mean, a $20,000 position, which is 800 shares or 850 shares of SolarEdge. And again, you risk $1%, which is 200, and you gain 1,600. That's 1 to 8. If you actually practice the strategy, which is sell at the close, do nothing, sell at the close. I mean, there are obviously ways to elevate the stop loss, for example, to this red line, but which is 2610 or 26 in this case. So there are ways. We're not going to go over through the whole trading course right now, but that's the concept behind smart trading. Use a very, very small pool of super aggressive, fit for day trading stocks, exercise your strategy on them, and try to extract profits as they move higher or lower with the trend of the stock. And the most important thing, keep your losses at 1%. I know that it's not 100% of the time. Sometimes you need to risk a little bit more. But the idea here is that trades, as you can see, almost on a daily basis, we're getting trades of 5% intraday, 7% intraday, sometimes even more, 3% intraday. Worst case scenario is that you lose 1%. That should be your lose scenario. You lose 1% on the trade. Okay, guys, I hope it was smart enough, illuminating enough. We'll have more of those examples this week. Thanks. Please like, subscribe, and do share this video with your day trading friends. Thank you.